Hello and welcome, everybody. Happy Friday. Welcome to the end of another week, a 3-day weekend, and another Sectors Made Simple webinar. Today, we have a lot to talk about because this past week has been a wild one in the market. It was Triple Witching Week, which we've talked about in our June market forecast webinar. It was also an FOMC meeting, which Sectors Made Simple subscribers got to hear my forecasts about in Tuesday's members webinar. But today is Friday, and we have a lot to discuss because we can now talk about what happened in that FOMC meeting. These meetings are very important because not only do they tell us what the Federal Reserve is doing, and mostly what they're changing about the federal funds rate, but... What's up? Oh, sorry. It doesn't just tell us what's going on with the federal funds rate. It also tells us quite a bit about where the Federal Reserve sees the US economy going. It provides us forecasts on where they think we are headed. So today, I want to take a look at those forecasts as well as compare them against what's actually happening today. There's a lot that we can look at in the future and try and predict, but there's also a lot that we can talk about of where we are today and looking a little bit back and mostly literally today to see where we are in all of this craziness. So today we're going to try and make some order out of chaos, try and talk about the FOMC meeting from this week, and share some ways that we can study the market in the weeks, months, and, well, years to come. So let's get straight into the action, shall we? So today we're going to be talking about the basics of a bear market, but more importantly, where we sit today with the economy and the stock market. Disclaimer, as per usual, I'm going to talk today quite a bit about forecasts and future results. Now, past results can never guarantee future performance, just like future performance is never certain. So please take everything today as an educational example and an educational resource. Trust but verify. I will provide you guys the source of where most of my information for this webinar is coming from so that you all can read through it yourself. I'm going to give a summary, but there is a lot of really great details if this kind of information is interesting to you that you can delve into yourself so that you don't have to hear me summarizing it. You can go to the source yourself. So let's get into today's webinar by first talking about what the goals for this session actually are. Last Friday, which was June 10th of 2022, the US economy, the US stock market entered a bear market. And by stock market, I'm strictly talking here about the S&P 500. But the Dow and Nasdaq joined it, dropping 20% below their previous high, signaling the beginning of a bear market. In the past, and by past I mean a couple weeks ago actually, we talked about some ways that we can invest in a bear market. Kira, can you find the link, please, for that bear market webinar? Kira will post the link down in chat for that webinar so that if you're interested, after this webinar, of course, you can go and take a look at that and see some actionable ways that we can invest in bear markets. But while we did cover ways to invest in a bear market, we didn't really talk about the state of the market as it is right now. So that's what we're going to do today. We're going to take a look at where the stock market is today, which is June 17th of 2022, and we can take a look at some information about where experts think the market is headed from here. If you're interested in that webinar on 3 ways to trade in a bear market, it is in the chat right now, as well as if you're watching this recorded, it will be in the resources section of the webinar down in the description. So let's get started by first talking about the S&P 500 itself. Just as a quick refresher, if we're trying to find the definition of a bear market, what that is it's an index or a market that falls 20% below its highest price. In the case of the S&P 500, this high occurred on January 4th of 2022, and we crossed the bear market line for the first time on May 20th. For minutes, quite literally minutes. But after that, the market recovered slightly and stayed pretty even, about 13 to 15% down from its January high until June 10th came about. June 10th, the Bureau of Labor Statistics, aka the BLS, because the US government loves its three-letter alphabet soup organizations. The BLS announced that inflation had increased to 8.6% for May. That the economy didn't really like, and by economy, I mean the stock market. The stock market doesn't like bad news. That was bad news, and it triggered a free fall across the US stock market. And it wasn't just the US market. Ripples of this event were felt across the entire international markets as well, with the Nikkei also dropping about 4% on the same day, being the Japanese market. So before we go into detail about the state of the market today, I first want to talk about this inciting incident, what this big event that caused this free fall actually was. Because really, this is what is shaping the market. Now, there are two things outside of just the stock market that we can really identify as problems. And for some reason, they're backwards. So, globally, one of the reasons that we're seeing pullback, not just in the market, but the entire economy, is the war between Russia and Ukraine, and also COVID restrictions within China. The global supply chain started to recover after COVID. However, in the past few months, COVID has had a resurgence within China, and due to China's zero COVID policy, they came down hard on trying to reduce the number of cases, and as a result, set the supply chain back another couple of months, if not years. Supply chains are this very fragile thing that relies on all of these different moving parts working perfectly. If one thing goes wrong, that small thing snowballs into a larger and larger problem the further down the supply chain we get. Factories in China, unsurprisingly, are pretty high up on that supply chain, so those effects ripple into many different industries and sectors, causing massive problems. And we do see that in industries such as staples that traditionally are very, very defensive, also having a really tough time the past couple of months, with large losses for many of the major staples companies that we see, including Costco, Walmart, Target. So those are the big things outside of the United States that are going on. But domestically, we've got two pretty big things changing as well. And they're kind of related. Inflation and the good old Federal Reserve. It's no surprise that inflation is the main downward pressure in the stock market at the moment. Again, the inciting incident of this bear market was quite literally the announcement of May's inflation numbers. For all of 2022, if we go back and we look at how the stock market responded every single time there's been a Bureau of Labor Statistics inflation announcement, when they announce the increase, the market reacts negatively with losses of 1% or larger. Now, as it stands, we have to realize this. Inflation is high right now. And not just a little high, very high. In fact, it's the highest that inflation has been since the oil crisis of 1980. The Iranian Revolution happened, and that had massive impacts on the supply of global oil, as well as OPEC moved to try and punish the United States due to their involvement in the Middle East, and as a result, US supply of oil was greatly changed. And with this change in supply, we saw huge shifts in the prices of oil, but consumer goods across the spectrum as well. So that's not great. Inflation is very, very high, and despite some efforts to decrease that inflation rate, nothing's changed. So we have to ask, what's actually being done about it? We really hope that something is being done because, again, these inflation rates haven't been seen since the last time that there was an oil crisis, back in the 1980s. So to answer the question of what's being done about it, we need to look at the Federal Reserve. Blaze is saying, I went to the supermarket today and a single mango was $3. Yup. That's not surprising. The cost of food and energy are two of the highest increases if we look at the CPI, the Consumer Price Index. And in fact, today we'll take a look at the CPI and compare it against the inflation metric that the Federal Reserve uses, which is different, called the PCE. Stay tuned if you want to learn more about that. So now, let's talk about good old Uncle Sam, his wallet, and the Federal Reserve. So what the heck is the Fed actually doing? Because really, it's their job to do something about this. The Federal Reserve is responsible for the monetary policies of the United States. And because of that, they are responsible for having a significant impact on the inflation rate. So what the heck are they doing? So they tried and are trying to change the direction of inflation. Back earlier this year, we saw the beginnings of their shifts in how they're approaching the federal funds rate. Due to this little global event called COVID and the restrictions in place because of it, the Federal Reserve dropped the federal funds rate to effectively 0%, meaning it was almost free for banks to lend to other banks. When it's free for money to move around between banks, it becomes cheaper for consumers and businesses alike to get money from banks. Go figure. When it's cheaper for banks to get money, it's also cheaper for you to get money from them. Now, in 2022, we have been moving out of the restrictions age and moving back into as everyone likes to call it, the new normal. But the new normal is not a very, very calm one. And again, inflation has been steadily increasing throughout the pandemic and has continued to increase as we move out of it. So we've seen the Federal Reserve try and make some adjustments to this federal funds rate. So far, we've seen 3 increases. The first one was 0.25%, the second 0.5%, and now we saw an increase on Wednesday of 0.75%. Now, this is a pretty substantial increase. It is the largest increase that we've seen to the federal funds rate since 1988. So is that cause for alarm? Well, if you're the stock market, apparently so, because a lot of the pessimism right now in the US stock market is due to the fact that we're not seeing the impacts of this rate change. Again, we've seen 2 changes to the federal funds rate so far, but 0 change, actually an increase in inflation in the United States. So money is becoming more expensive for us to borrow, but also everything in life is becoming more expensive because inflation's really, really high. That is unsustainable. And we've got to remember this, because again, that's the fear side of things. And the goal today is let's get away from fear and let's get back to the world of what's really going on. And remember that while what we're living is unprecedented, what's happening in the economy really isn't. We have to look back at the history of the Federal Reserve and how they make changes to the federal funds rate. In Tuesday's webinar, we went into detail about this, where we found that every time the Fed fund rate increases, on average, inflation still goes up by 0.2%. Why? Why in the world, if what the Fed's job is to do is help lower inflation by raising this federal funds rate, does that mean that they really suck at their job if when they increase this rate, inflation still goes up? Not exactly. Because there's one thing that we haven't really talked about yet, and we will talk about in today's class, which is unemployment. When the federal funds rate goes up, it also rises. Yes, it's supposed to lower inflation, but it also causes an increase in unemployment. Unemployment is something that is very dangerous to play with. So the Fed has to kind of play it safe. They need to be okay with immediate results not happening. Because if they overestimate, if they make too big of an adjustment, yes, inflation's going to go down, but unemployment is going to skyrocket. And while an economy that's growing out of control or the prices are growing out of control is a bad problem, high unemployment is an equally large, if not larger, problem. So the Fed really is kind of stuck between a rock and a hard place. U.S. consumers are freaking out because of the high rates of inflation, but also U.S. consumers can't afford to lose their jobs because of the high rate of inflation. Somewhere in the middle, the U.S. Federal Reserve is trying to figure out what in the world they do. That's the state of where we're at. So what happens next? Well, hate to say it, no one has any clue. Well, some people have a slight clue. The Federal Reserve, again, we're talking here about the percent increases that they've made, not the actual percent of the Fed funds rate. The Fed is getting extremely aggressive about how they approach this Fed fund rate, with, again, that 0.75% increase being the largest that we've seen since 1988, but is not unprecedented. If we look back at the history of the federal funds rate changes, back to the crazy 70s and 80s, the Fed liked to mess with that rate quite a bit. There were periods that the federal funds rate in a single change went up by 6%. The highest Fed fund rate we've ever seen, 3 times by the way, not just once, 3 times, was a Fed fund rate of 20%. So if you wanted to go and buy a house, chances were if you tried to buy a house in that market, your interest rates for that house were probably going to be in the range of, a modest 24 to 26%. That's affordable, right? So the Fed has definitely calmed down. Thank God they've calmed down a little bit since the 70s and 80s. They've grown a little bit, they've gotten older, and they've gotten a little more conservative. And I'll take that. But because they've gotten a little bit more conservative about how they make changes, it's difficult for us to know what happens next because we're not sure how quickly things will actually react to their small, itty-bitty tiny steps in what we hope is the right direction. But who better to give us an idea of what we should expect than the Fed themselves? And this is where the meat of today's webinar comes in. We just talked about the side dish. We'll get to go to dessert later, but right now we get to talk about the main course. Because at the end of every quarter, which by my non-existent watch is June, we get the FOMC meeting. And with that FOMC meeting, which was this past Wednesday, we get what's called a summary of economic projections. If you are not a person that likes statistics, this might be a little tricky, but these summaries are very statistics heavy, but I'll do my best to distill it in a way that is very useful for us. Now, if you are curious about the entire report, I will include a link to the entire report. For anyone that likes data and is very curious about this kind of stuff, this report is gold. So there is a link to the summary of economic projections from this past meeting, which was on Wednesday, June 15th. But again, if a bunch of statistics are crazy and you don't want to deal with that, stay tuned, because we're going to talk about that right after this commercial break. Okay, we don't have any commercials. Let's go talk about this. All right. So, what does this summary actually include? Well, everything. It is the FOMC and all of its representatives putting their money, well, not their money, but putting their careers where their mouths are, where they are responsible for saying what direction they think things are headed. And what they measure and what they include their predictions on are things like GDP, which is how much stuff the US produces. GDP is important because that's how we determine a recession. A recession is found in changes in GDP. So that will tell us, do they think we're headed to a recession? Unemployment is the next one, because we said the federal funds rate, when they make too big of changes, impacts unemployment. If they make things too expensive, businesses scale back. Part of scaling back is letting people go, and that causes unemployment to go up. That is not healthy. So we get to learn about where they think unemployment is headed. Then we get inflation, but not the inflation that you and I are used to seeing. And then finally, because this is what they really have control over, is the federal funds rate. Now, the great thing about these projections is they're not just saying, where do we think things are going to be in the next quarter? It's not a 4-month prediction. It is the next 3 years of predictions, and even beyond that. They literally have 2022, 2023, 2024, and future. What future is, well, I guess only time will tell. But let's take a look at what we can actually learn from this June 2022 summary of economic projections, and see if we can take anything out of it to try and learn where the authority on the US economy thinks we're headed. Are they perfect? No. But if there's anyone that we should look to for information about where the economy is headed, this is probably one of the best places that we can look. Without any further ado, let's take a look at the summary of economic projections. Let's start with the big one, GDP. Why? Well, because in Q1 of 2022, we saw the GDP of the United States decrease by 1.5%. And the reason that's important is because a recession, this big scary idea that sits in the back of investors and everyone's heads, is defined by a period of 2 consecutive quarters of GDP losses. Q1, we had GDP losses. Q2, which is where we are right now, we're finishing up Q2, puts a lot of attention, and rightfully so, on where that GDP change is. Because if it's negative, then we hit the technical definitions of a recession. Now, I'm sadly going to burst your bubble if you're thinking that we're suddenly going to have an idea early about if we're going to be in a recession or not in the coming months. No, the summary of economic projections does not tell us what's happening next quarter. I wish it did. All we get to know is where the Fed thinks things are going to be by the end of this year. And we don't just get to hear what their average is. We get things like the median. So what if we took all of the people and kind of knocked off the highest and the lowest, the next highest and the lowest, so on and so forth, until we get to the middle guy. We get to know that. We also get to know the range, what the highest was and what the lowest was. And that's what we're going to cover today. We're going to cover those ranges because it will give us an idea of where everybody's thoughts are. Not just the guy that was the least optimistic or the most optimistic. We get everyone's thoughts in between. Now, here's where things get interesting. For the end of 2022, every single one of the FOMC members projected that our GDP was going to see an increase of 1 to 2%. All right, cool. That means that we're going to avoid a recession, right? Not so much. Because while, yeah, that means that the GDP will increase, we also, again, we get one of these reports every quarter. So we don't just get to know what they're thinking today. We get to say, all right, what were you thinking 4 months ago, back in March? So the March summary had the forecast of our GDP change being 2.1 to 3.3%. Still positive, but where we're at right now is lower than where the forecast was just 4 months ago. So that gives us a little bit, it's where you're walking outside and you're ready to go for a run. The sun is shining and everything's beautiful, but there's storm clouds in the distance. We think we know where things are going to be, but we're never certain. Now, again, now we've talked about GDP, and this is going to be our indicator of, and not just, we think it's an indicator, it is quite literally the metric that is used to determine a recession. Economists do use a number of other factors, but this is one of the biggest historically and is still one of the most commonly used for gauging the status of our economy. So let's move on to unemployment, because if there's any part of the market that we'll see an effect, is the part of the market that affects us, our jobs. And again, this is part of these forecasts and part of the economy that we oftentimes forget is the fact that these policy changes have an impact on our jobs and on the unemployment metrics that we have here in the US. So when the Fed fund rate increases, just as it has 3 times this year, it becomes more expensive for people to borrow money. Not just people like you, me, and Juan de los Palotes, but also businesses. When it's more expensive for a business to get money, business growth slows or even goes backwards a little bit. And when that happens, it slows or shifts unemployment numbers. Now, thankfully, the FOMC has a pretty good idea of their target for unemployment. And target is honestly a bad word to use here because no one wants to be willfully or unwillfully unemployed. But it's the fact of the matter. It does happen. And we have an expectation of what that unemployment, again, healthy is not the right word. There's no right word to positively describe unemployment. But the target unemployment rate is somewhere between 4 to 5%. That's where we expect things to be and is not cause for concern and panic. Now, the outlook for unemployment has not changed from where it was in March, or it hasn't changed much. So their current expectations for unemployment for 2022 sit between 3.2 to 4.0%. Underneath that bottom line of their target. And extending that to 2023, we do see an increase where they are pretty well unified in that they think it's going to increase somewhere in the range of about 4%. To about 4%, that is, not an increase of 4%. So not cause for concern to any extent, really. It is within tolerance, and they're pretty confident about where they think it's going to go. But the moral of the story here is unemployment will increase because we expect the federal funds rate to also increase. Now, let's take a look here at inflation, because this is really the big one that everyone talks about, and again, was the inciting incident for the current bear market. Now, bad news. The summary of economic projections uses a different inflation metric than the one that we're used to seeing, and that 8.6% one that we talked about earlier in this webinar. They choose to use one, or rather the one that you're used to seeing, is CPI inflation, Consumer Price Index inflation. What that is the average change in price of things, everything, paid by urban consumers, people that live in big metropolitan cities or their suburbs. Those are the CPI people, but it's not everyone. The Fed tries to look at everyone by looking at what's called the PCE. The PCE does include non-urban households as well, but unfortunately, it excludes things that right now are massive weights on this inflation. Energy and food. Because I'll tell you what, you might not be able to notice that the price of a lawnmower has gone up. You might not realize that the price of a new desk has gone up. But I bet you that you can tell me that the price of that mango at the grocery store or my Chipotle burrito that I can't get with guacamole anymore, those definitely have gone up in price. So has the price of gas. So, unfortunately, the PCE inflation ignores those. It ignores our Chipotle burritos, and it ignores the price of gas, which are two of the biggest stresses that we are really feeling. So please keep that in mind, that when we're talking now about these changes in inflation, the numbers we're talking about exclude food and energy. So I want to forget that 8.6% number. Let's refocus and look at the PCE inflation rate, which in April was 6.3%, compared to the 8.3% or 8.6%, current 8.6% from April 8.3% inflation rate. So now that we've refocused and we know that we are talking now about a 6.3% PCE inflation, let's actually talk about the Fed. The Fed is pretty mixed on where they think inflation is going to go, with a pretty large spread of 1.4%, where they expect a change from 6.3%. By the year end, they expect that number to go from anywhere from 4.8%, so a pretty substantial decrease of about a third, to 6.2%, aka nothing changed. Great. So we could either see a 33% decrease or absolutely no change. What the heck do I do with that? Well, this isn't the good news that we were looking for. It kind of is a step in the right direction, because they don't expect inflation to continue to increase. Now, this is only one piece of information. And that piece of information is mixed. We could see a 33% decrease or no change. So let's take a step further. Let's look beyond just 2022 and let's go into the future and talk about 2023. Because this is where we get some context for where things might actually be heading, and we start to see a trend. Their estimates in 2023 are much more comfortable for us, where we see that PCE inflation dropping to 2.4 to 4.0%. Still a pretty large spread, but universally, that means that the Fed expects, everyone in the Fed expects, that inflation is going to trend downward at least 33%, at most almost 60% by the end of 2023. By 2024, we can expect that rate to get back down to their target, around 2 to 3%. So what this means is that the Fed, the governing body of monetary policy in the United States, looks at inflation and says, well, it may or may not change in the next 6 months, but by the end of next year, it'll get better, and by 2 years from now, 2.5 years from now, it should be back to normal. All right. It's not the best thing ever, but it is promising. Before we go on to the Fed fund rate, I want to just share a quick little analogy for you all. Because whenever we're talking about inflation, the Fed fund rate, and recessions versus bear markets, we need to remember this. We can think about the US economy and the stock market like a forest. And the Federal Reserve is the forest agency. They are responsible for keeping the forests safe and growing. Unfortunately, wildfires happen. And Smokey the Bear, the only you can prevent wildfires, is totally wrong. Wildfires cannot be prevented. Recessions and bear markets cannot be prevented. The best thing we can do is the approach that the Wildlife Service really uses in real life. We can't prevent wildfires, so instead we should prepare for wildfires. That is the way we should look at potential recessions and current bear markets. They are normal. They are not the end of the world. They are not unprecedented events. They are pullback. Because right now, it's not a surprise that inflation is unsustainable. It is causing a stress on our everyday lives. The only way that that gets fixed is if it either comes down or everything shifts until it's back in balance. That is what we should be looking at here. We should not be looking at all of this with panic and not knowing where things are coming or what's coming next. What we've seen so far from GDP, unemployment, and inflation is that we're going to be moving towards normal. It might not be in the next 4 months, but by 2024, the Fed universally expects us to be back at normal. That's not me saying that. That is the Federal Reserve and the FOMC members saying that. So now let's see how they plan to adjust the federal funds rate, the tool that they actually have full control over to make these changes happen. So yes, 40 minutes in, we finally get to talk about what I said on slide number 3, the federal funds rate. Because this is where things get pretty interesting. Remember that the current Fed fund rate, as of today, well, rather as of Wednesday, June 15th, is set between 1.5 to 1.75%. By the end of 2022, we're likely going to see this rate double to anywhere between 3.1 to 3.9%. So what that means is there's not too many meetings left in the year. There's 4 FOMC meetings left in this year. So in every single one of those meetings, expect to see a pretty large increase as they try and reach their target of over 3% on the federal funds rate. Now, again, they are slowly moving up to that, but it's not like they're just going to shoot all the way past. They have a goal in mind. And that year-end result is their goal and is pretty close to the highest they see things going. In 2023, their estimates range between 2.9% and 4.4%. And by 2024, the spread becomes a little bigger, between 2.1 and 4.1%. Now, we're just coming off of a very interesting period where we had almost 2 years of basically 0% on the Fed fund rate. And we kind of got used to that being the new normal. Money was cheap to borrow because the US economy needed it to be. That is no longer the case, and the Fed is trying to move us away from that. And while 3.9 or even 4.4 seems like a pretty high rate, it is 3 times higher than where our interest rates currently sit. It's nothing new. Again, 3 times in the history of the Fed fund rate, we've seen 20%. And if we take the average rate between 1971, which is when the Fed started to make their own adjustments to the Fed fund rate, and 2022, which is, hey, today, we see an average rate of 5.44%. So what does that mean? That means that even by their least conservative estimates, the worst case scenario that the Fed sees, we are still below the average for the historical federal funds rate. So hopefully that should give us a little bit of comfort in terms of where we might see this rate headed in the next few months. So when we see increases, these steady increases throughout the rest of the year, do not be surprised. And to really illustrate this, I want to take a look at that projection sheet, because as part of that projection, they actually tell us where every single one of the members predicted. Each one of these dots is a person from the FOMC. This is their 2022 predictions. Everyone predicts at least 3%, with one person predicting between 3.75 and 4%. Basically, the majority of people are thinking somewhere between 3 to 3.5%. In 2023, we see that increasing, where we see the rate going. Now most people are sitting around 3.5 to 3.75, and the average is in that 3.75 to 4% range. From there, things start to spread out a little bit, but the focus is in that 3.25 to 3.5%. So with this, what we can draw from this is that there is almost certainty that the federal funds rate will continue to increase throughout the year. The news is going to blow up with it. The federal funds rate continues to increase and blah, 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 blah. Remember the facts. Remember that this is expected, and this is part of their plan. So now we have benchmarks throughout the rest of the year that we can track to see how closely these predictions get to reality. And that's where all of this really heads towards, is having ways to keep track of key economic metrics for us to follow and seeing how close the Fed actually is to their predictions. So now, let's get back to the big question that many of you are probably still asking. If the projections only cover 2022, what about while we're still in this year? Are we headed towards a recession at the end of this quarter? It's possible, but based on forecasts by the FOMC, either probably not or not for long. Let's go back 1 or 2 or 150 years. Since 1857, we've had a number of recessions, but the average recession has been 17.5 months. So about a year and a half. If the FOMC forecasts are correct, which they're not always correct, but again, this is where key decision makers' heads are currently at, so it's the best we've got. If their forecasts are correct, we will see GDP growth by the end of 2022. That means that if we were in a recession, it wouldn't be for long. But what does that mean for us in the meantime? Well, sadly, it leaves us with a lot of questions. Most notably, what the heck do we do next? Because yeah, we know where things are going to be at by December, or where things might be at by December, but it's June. I'm not sitting around on my hands until December before I do anything. Because the Fed predicts what will happen in the future, but we don't invest in the future, we invest in today. So let's just look at the market today, and we'll find that things aren't looking great. Every single sector in the S&P 500 is in a downtrend. Or not just downtrend. By that I mean more companies are going on sell signals than they are on buy signals for every single sector across the NYSE. If we look at how many companies are on these sell signals, for 9 of the 11 market sectors, the 2 that are not in this, by the way, are energy with 50% of its companies in sell signals, and financials with 60% of its companies in sell signals. We find that over 75% of companies in 9 of the 11 sectors are in sell signals. So almost 3/4 of the stock market are on sell signals. And within the S&P 500, every single sector ETF is currently in point and figure sell signals. So right now, we are pretty solidly in a bear market. But the thing is, we don't really know where the bear market ends. Now, the next question you're probably going to ask me is, how do we invest in the bear market? Martha has a question. ¿Cómo encuentro las clases de Julie? Para obtener la enlace, por favor, envíanos un email a support@sectorsmadesimple.com y podemos ayudarte con la enlace ahí. Gracias. So, how do we actually invest in this bear market? Well, we only have 12 minutes left, and sadly I can't cover all of that because it took me an hour to do it last time. And by that I mean, I've explained it already, and what I shared is still valuable. So I highly recommend going to take a look at our 3 ways to invest in a bear market webinar if you want to actually learn how to trade in this bear market. So just as a quick summary, the 3 methods we talked about were high dividend yield companies, inverse ETFs, and options. Now, that is a good starting point. But how do we know where we're currently at in terms of the overall stock market? Not just little ways here and there to make money. No, how do we know when the entire current has changed direction? Well, to answer this, we need to look at 2 cycles: market cycle and economic cycle. These 2 cycles are related and give us an ebb and flow, a push and a pull of not only bear and bull markets, but of recessions and recoveries as well. Note, these are not perfect. And by that I mean, it's not the only thing that's going on. It's like trying to say, when you're sailing a boat, that the only thing affecting which direction you go is the current. No. You've got a motor, there's wind, there's many things that are pushing you in different directions all at the same time. We've got to look at the market the same way. That market and economic cycles are the current. The wind is everything else happening in the world. And the motor is the direction that all of us want to be trying to go. Now, again, while these are not perfect, it is more information for us to understand what we're currently at. So let's take a look at the market and economic cycles. What we see are that the market cycle comes before the economic cycle, and that there's this up and down pattern to it. And to understand where we're currently at in the cycle, what we can do is we can look at sector strength. What better way to do that at Sectors Made Simple than looking at the Sectors Made Simple relative strength matrix? This matrix takes not just where things have been, but looks at today and tells us who the leaders are in this moment, and gives us a really great way of seeing these cycles for ourselves. So here is the current matrix as of June 17th, 2022. Our current leader is healthcare, followed by staples and utilities. Until this week, energy was our leader with a total count of 22. Energy got slammed this week with the largest change we have ever seen on the matrix of minus 20. That is absolutely insane. So energy is the outlier here, because there's a lot going on with the energy sector that is not market and economic cycles. It is what's going on with Russia and Ukraine. It's what's going on with oil reserves in the US. There's too much there to attribute it to market cycle. So push that aside. Let's focus on the other ones. Healthcare, staples, utilities. Healthcare, staples, energy. But in the next market, or in the next part of it, we see utilities. So, and then financials is somewhere in the middle of the pack. So what we're seeing here is that we're in a bear market moving towards full recovery and that early recession. So according to the market cycle, forgetting energy, we are sitting in the beginning of a bear market. According to the economic cycle, we're rounding the top of that full recovery into an early recession. So if you only looked at the economic and market cycles, yeah, we're in a bear market. Yeah, we're on our way to a recession. But please remember that these cycles are not perfect. They are an estimation. They are in a vacuum kind of scenario. And there are things that are going on in the world that the economic cycle cannot include. Things like the war and also supply chain issues in China. But let's bring everything home and talk about the whole picture. We've talked today about the FOMC, their predictions. We've talked about the stock market and its current status. We've talked about the economic cycle and where we sit with that and the market cycle. Some things have agreed with each other, some things have not. But here's the reality of it all. No one piece of information we said today is going to give us the whole story. It can't. There's too many things going on, and history is written as we live it. So the only way for us to know what comes next is for it to happen. And like we've seen with where the FOMC thinks we're headed and where the market and economic cycles think we're headed, some conflict with each other. The market cycle says, yeah, recession. The FOMC says no recession. So which one's right? Unfortunately, we're not really sure. So the best thing that we can do is what we've done today. Look at everything. Go to the source of the information. Don't read on Motley Fool that, oh, we're headed straight into a recession. Look at the numbers. Look at the facts. Go to the source of the information. Find out for ourselves what the real data behind it all is. The summary of economic projections gives us a very, very good starting point. These well-established market and economic cycles give us a very, very good starting point. And taking these two pieces of information together, as history has shown, and then putting it together with where we currently sit today, we can get at least an educated opinion of where we're headed from here. And I promise you one thing, just as we've done for the past month with the onset of the bear market, June market forecasting, and today's recap of the FOMC meeting and their summary of economic projections, you can bet that us here at Sectors Made Simple will be here ready to talk about these events as we live them and as we start to see what 2022 has in store for us. So, what's up? So, if everything today has been interesting to you and you enjoy learning more about finance and more about the stock market, share this knowledge with friends and family. And if they're not ready to digest the stock market, we have a great way to get you started. We have an upcoming class series starting in July, on July 10th of 2022, July 11th of 2022, which is called Figuring Out Finance. This is going to be a 10-lesson crash course over 5 weeks that will teach you the basics of investing, but also money management. This class is meant for anyone that wants to get started with budgeting, with investing, with getting control of your finances, and gives you the resources to do so with lessons, but also projects. The projects are not graded. There is no necessary assignments. Instead, these projects are meant to give you a way of taking what you learn in class and applying it. These classes are meant for students that are just earning their first dollars and are already expected to know how to manage it, to adults that want to gain more confidence by gaining control of their investments and their money overall. So if these classes are something that's interesting to you or to a loved one or to your kids, I highly recommend taking a look at the information that we have on that class series, which is posted now in the description or in the resources section of this webinar. The classes are limited in seats because, again, the goal of those classes is to give everyone personal attention. You will have direct access to me as well as my mom, who will be teaching the course, and are meant to be an experience that you can directly talk with me and her to accomplish your financial goals. Start yourself off on the right foot by learning how to figure out finance with us here at Sectors Made Simple. If you need any more information or have any questions, you can email us at support@sectorsmadesimple.com. And hope you all have a great Juneteenth weekend. We'll be back next Friday to see how things are shaking out in the market and share more resources on how we can all invest simpler. So thank you all so much. Have a great weekend.